What you don't know can hurt you, and what you do know can set you free. That's why we interview subject matter experts for your small to medium sized business and personal finances. Because knowledge is power, but experience is everything. Welcome to The Tipping Point. The Tipping Point is brought to you in part by Tirani and Velez LLP, your tax and accounting subject matter experts. Welcome to the show, everybody. I'm your host, Gabriel Velez. Our guest today is Chris Williams, Home Lending Officer at Citibank. Chris has been in the mortgage industry for over a decade and worked in the financial services industry before that. Welcome to the show, Chris.
Good morning. Long-time listener, first-time caller.
Thanks for being on the show, man. I really appreciate it. And, I think this is a really interesting topic, especially right now while the economy is doing really well. And, everybody in Orange County loves real estate, residential real estate specifically, but also on the commercial side. So, yeah, thank you.
Yeah, exciting times. As you've seen in the local paper, we've got about 60,000 new families that can afford to purchase a house that couldn't afford to purchase in 2017 and 2018 due to the low attractive interest rate environment. So happy to be a part of the discussion.
Yeah, that's interesting. We should actually touch a little bit on that a little bit later. But let's start off. Right now prices are high. Should people wait to buy a house, or should they jump into the market? What do you think?
So great question. And I would say if you could afford the payment, you need the tax deduction, and you currently have rising rent,
Yeah.
it's definitely something to think about.
Okay. Is it so like from a financial perspective and a cash flow perspective? Do you feel that homeownership's a good idea because you're hedging against the increasing rates of rent, or what's the deal there?
Yeah, so I think the main three reasons to buy primary residence would be number one, to beat inflation, because we have interest rates, we have rent that continues to rise.
Mm-hmm.
We've got fruit, gas, grocery, entertainment that tends to go up, right? So if you can lock in a house payment that's going to stay the same for 30 years, then you're going to be ahead of the game, and your paycheck should be growing as your mortgage payment stays the same. So that's going to help build your net worth. So that's the main reason, which is beat inflation. Second reason is to build equity. So no one likes to pay rent and not have anything to show for it at the end of the year.
Yeah.
So you can build equity. Of course, there is a cycle of interest rate. It's usually 7 years, just like the stock market. So you'd have to be committed to staying in the property for at least 7 years. And that doesn't mean that you can't move out of the property, but you could turn it into a rental home and you just want to maintain it. You want to retain that property. So over time, you're going to build equity in that home. So that's the second main reason. Third reason is no one likes paying Uncle Sam. So if you've got taxable income, then
Yeah.
you've got a good tax advisor like yourself, then they could explain to you the tax benefit.
Yeah, and there are obviously been some rollbacks as far as tax benefits, with the new tax laws and the decrease in deductible mortgage interest down to $750,000 of principal debt, and then also a little bit on the real estate taxes. But I always tell somebody, don't make a decision primarily or exclusively for tax purposes. Make the right business decision and make the right decision for your family, and then look to make that tax efficient afterwards. Yeah.
I completely agree. And when we talk about, rising real estate prices, we're also thinking about our rent. How rent continues to go up. So, as you know, in Orange County, the average cost for two bedrooms over 2,800 right now,
Right.
and that goes up every year. So that's not a fun thing we've got to look at, year after year. We're planning on moving to get, better rent. So to think about the rising price of real estate and rent together is really important. Now, if you're in a situation where you're living rent free with family and you're able to build up a little bit more down payment and maybe get to a lower payment on your mortgage by putting more down in the next year or two, then that's definitely part of the planning process. And we'd want to uncover that and decide maybe this isn't the right time to buy, but maybe, we've got time in the next year or two.
Yeah. Um, Yeah, interesting about rent and how expensive rent is, and my office is here based in Irvine, and rent is ridiculous, and you get the smallest yard ever, and there's a trade off obviously for Irvine company and like living in Irvine, which is it's really really convenient, right? Everything's pretty much walking distance, especially here in the Spectrum area, but definitely seems a non-traditional trade, like as far as value versus the amount of money that you're putting out.
Right, and it's just hard to know, where we land, right? Because there's so many different programs and guidelines and government subsidies out there. So I think, my role as a home loan officer for the last 16 years, and being a financial advisor prior, is to help that first-time home buyer uncover their purchasing power, go over, what that price range would be, what that maximum payment would be, and then just decide if they're comfortable with that payment or if we need to back down on the price range, and then also have them meet with their tax advisor to go over possible tax deductions, and also their financial advisor to see if this is the time to move some of their investments.
Yeah, interesting. And then, so you talked a little bit about building equity. Obviously, everything is so expensive right now. It seems like maybe things are even overvalued, and we're waiting for a correction. So that's why you say look at home ownership and buying real estate as more of a long term play, right? You holding on to it for at least 7 years to kind of go through those ebbs and flows.
Exactly. So you look at it as a long-term hold, just like your stock or bond portfolio. So you
Yeah,
have to be committed to not necessarily living in the property for 7 years, but at least owning it. And if you're going to have a job change or an expanding family, you can look into possibly renting that property out and moving to another property, but you want to be committed to at least holding it for 7 years.
gotcha. Okay. So what kind of programs are out there? And obviously we gotta kind of be a little bit conscious of the bank's regulations and things with like what we can actually talk about. But what kinds of programs are out there for like host home first time home buyers? Is it,
Yeah, there's a lot of programs out there
yeah.
from all over, from different banks and lenders. They have different requirements, so it's a little bit hard to go into that on a podcast. But
Yeah.
there are lower down payment options.
Hmm.
There's government subsidies depending on if you're going to be buying as a primary residence, and that came out with the Consumer Protection Act. So
Okay.
that basically means that banks have to give back to their local community environment, and the way they do that is they can give you some subsidies and this is throughout all banks in the industry. So this allows them to help with possibly down payment assistance or waiving mortgage insurance. So some really exciting programs, and then you couple that with low interest rates,
Yeah.
it does make it much more affordable to purchase, and also it just makes it closer at hand.
Yeah, so some of these programs, like an FHA program or something, where you don't have to put as much down. You don't have to put like the conventional 20% down. You could put down 4%, 3%. Um, in your experience, is it better to leverage more, early on and kind of hoard the cash if you have it, or is it better to put a higher down payment and get the lowest loan possible?
So great question, and this really comes up with anyone that's purchasing a house, right? How much should we put down, and how's it going to affect my payment, and what's my opportunity cost? Really, opportunity cost is the theory. So opportunity cost is looking at what your average rate of return is on your savings, your investments now,
Hmm.
and then what's the interest rate that you're going to pay on your mortgage.
Yeah.
So this is something that, of course, you meet with your financial advisor or your tax advisor, and they can give you an idea of what's your average rate of return for the last 7 to 10 years on your investments or retirement account, right? So if you're averaging 7 to 8%, and your new mortgage might be 3 to 4, then your money's going to go twice as far in your investment accounts than it is on your mortgage.
Yeah.
So if you can find a comfortable payment and keep more money in your investment accounts, then that's going to allow you to build your network higher because your money's going to go further. Plus, there's liquidity too. So,
Mhm.
we all have, the average American has 5 careers in their life, right? So that means that you've got to have a job change every once in a while. That's just the way things work.
Yeah.
So having liquidity in your investment accounts goes a long way if you're going to be changing jobs, if you're going to be expanding your family, if you're going to be starting a business. So once you put that money into your house, it's not going to be as liquid as if it was in your investment account. Your investment account, you can generally get money out within 3 days, is when trades settle. So it's a lot easier to get that money out of your investment account. So thinking about that, the opportunity cost, and thinking about, once you get to the point of retirement and you've built up all of that money in your investment account, it might be more than the same amount that you would be putting down in your home in increments. So if you're putting down a specific, $500 more on your mortgage per month or $500 in your investment account,
Yeah.
at the end of 20 years, which one's going to actually make more of a difference? So that's what your, financial advisor and tax advisor will help you work on. And then, looking at specifics as far as, okay, if you decide you want to put an extra 10 or 20,000, how's that going to affect your payment per month? Is that really going to be helpful, or is that not going to make much of a noticeable difference?
Yeah, I think lack of liquidity is where a lot of people get in trouble. Back in when the bubble burst in 2008, right, and people couldn't make their mortgage payments, and it was because lack of liquidity and lack of planning, right? So not to mention some bad things going on in the banking industry, but so yeah, I mean, maintaining liquidity, and it definitely makes sense from a mathematical standpoint. Like you pointed out, if you can get a higher return than what you're paying on the money that you have borrowed, it makes mathematical sense. There's also the psychological side to it, right? And like you were in the financial services industry before you went into mortgage, so you understand like what are you doing with that liquidity? Are you investing it? Are you growing it, or are you spending it on expensive meals and vacations and things like that? And are you going to be actually better off because you maintain that liquidity for investing?
Yeah, and that's a great topic. So for people that maybe aren't investing and their money's just in a traditional checking or savings account, so they're not getting a higher rate of return,
Yeah.
of course their money's going to go further by having a smaller mortgage.
Right. Yeah.
And also, if a person that's buying a home is in the habits of maybe going to fancy dinners, fancy cars,
Yeah.
then having a higher mortgage payment could be a forced savings plan.
Okay.
Having a shorter term mortgage instead of a 30-year, having a 15-year, that could be a forced savings plan. So now you're forced to cut back on those, lavish expenses that we love so much in Orange County. So,
Yeah, we got a lot of great restaurants around here, right?
too many, possibly.
Too many, yeah. Great. So also on the topic of whether to put more down on a loan and not to put or to put the maximum amount of down on a loan and shorter term payments and things like that. There are also these things called ARMs, right? Adjustable rate mortgages. Can you kind of explain what those are?
Yeah, and those are very popular in our area because of the high balances that people carry.
Mm-hmm.
So, let's just say $1 million loan amount, right, or 500,000 loan amount. Let's say 500,000, right? So, right now the average difference between a 30-year fixed and a 10-year ARM loan is about 0.5% with some of the banks and lenders out there.
Mm-hmm.
So that would equal over $200 per month in savings on a $500,000 loan.
Yeah.
So that's a pretty big difference because if you think about how much, what does it take you to earn on your paycheck to be taxed to get the $200? I mean, that's kind of a big difference.
Yeah.
And more importantly, it really has to do with what's suitable for the homeowner. So when I say what's suitable, that would be, are they planning on selling or refinancing within 7 or 10 years? And if they are planning on selling or refinancing within 7 or 10 years due to expanding family, job change, whatever it may be, then they should really look into the ARM loan. On average, what we see in Southern California is people tend to sell or refinance every 5 years. And then the cycle of interest rates, just like the cycle of real estate, is every 7 years. So we should see a decrease every 7 years. That's been a little bit compressed. And of course, we can't accurately estimate that,
Right.
year over year, but that's what the economists are telling us is that over the last many decades, we've seen an average of about a 7-year cycle of interest rates.
Okay.
So most people refinance within that time frame. Also, there's no cost refinance options, and there's not prepayment penalties with most banks and lenders. So it makes it real easy for you to refinance if you're getting to a point where you have an ARM loan and you're seeing a better interest rate. So for someone that's going to have a smaller loan, there's not going to be that much of a payment difference if you're going to go from a 30-year fixed to an ARM loan. So you might might just prefer to have that extra comfort level and decide to go with a fixed loan.
Hmm.
But for many of us, we find that we're not going to be in the house for 30 years. So the longest time frame that someone's in a house in the country is actually in Chicago, and that's 12 years. So
On average, yeah.
that's the average. That's the longest time frame people keep houses in the country. Happens to be in Chicago, and that's 12 years. So you can see, that's less than half the time of a 30-year fixed. So, maybe the 30-year fixed isn't the most suitable, but we have to find that comfort level. And with first-time home buyers, usually they would prefer to go with the fixed. And then as we get older and we own multiple homes, we realize that maybe the ARM loan is the most suitable.
Okay, so a little bit on the mechanics of the arm load. So typically, you're going to get a lower interest rate than a traditional 30-year fixed, right?
Hmm.
Yeah. Okay, and then during that period, right? The like if it's a 7-year arm or a 10-year arm, is it mostly interest that you're paying during that period, or is it a similar amortization to a fixed loan?
So that's a question we get a lot, and it is the same amortization loan as a 30-year fixed loan.
Okay.
So the only thing that would change is at that adjustable rate period, there could be an adjustment in the interest rate up or down.
Okay.
And that's the way it is with most lenders and banks.
Got it. Okay, so there's just a risk if you actually end up staying in the home, and it hits the end of the arm term, there's a risk on where the interest rate will be at that point, right? You're kind of leaving yourself up to that.
Right. Yeah. If you do keep the ARM loan past the adjustment period, that's when the risk sets in.
Yeah.
If you sell or refinance before the end of the adjustment period, or before the end of the fixed period, and before it adjusts, then there's really not any type of risk. So it really depends on the plan for you and your family, how long you plan on being in the home, and if you're thinking about refinancing before then. And there's a lot of reasons that people tend to refinance, not just to lower their interest rate. Sometimes they would prefer to remodel their home.
Hmm.
So where we live, a lot of the homes by the beach communities, like where I'm at specifically, they were built in the 60s and 70s. So
Right.
sometimes you just don't have enough funds up front, coupled with your down payment, to really get the house where you want it to be. So over time, you can pull that equity out to remodel, to invest back in your house, increase the amenities, and help increase the value of the
Yeah. I bought my home and first time home buyer in 2012.
home.
It was a good time to buy a house. The prices have gone up probably 30% since then. Um, and so if I wanted to, there's an opportunity to pull some money out. Definitely, there's equity in there to remodel the home and make it maybe a little bit more lavish and
And we do see people pull money out for a variety of reasons too.
yeah,
So sometimes they'll pull to help with financing college education for some of their kids.
yeah,
Sometimes that ends up being a lower interest rate, lower payment than some of the student loans that are out there. And if you think about attorneys and doctors, sometimes there's not enough student loan available for that type of education level. So there's quite a few different reasons to think about refinancing when interest rates are low. Some people use it just to pay off high interest credit card debts too, or um, you know help move their business to the next level. So a lot of reasons to possibly refinance besides just lowering your interest rate.
yeah. And by the way, I haven't. I didn't take I didn't take a bunch of money to do like hardscaping and put a pool in my backyard. Like, I actually don't think that's a wise decision necessarily. You might over improve a home and never get your investment back. Maybe if you plan on living in that house for the rest of your life then it makes sense. But yeah, sometimes pulling out equity to buy another investment or a business, I think is also uh, can be a good idea. Yeah, or a good source of funds, right? If where there isn't another source of funds. So, um, so when somebody's out there shopping for new loans, what should they be looking for in a lender?
So you definitely want to meet with several lenders, and you want to find someone that's experienced, that can communicate the concerns that you have and help you understand exactly what to expect. And not only provide, of course, aggressive pricing is a must, right? So it's a competitive industry, but also make sure that they're able to meet those deadlines and clearly help you understand exactly what's needed from you So I would say that's very, very important, and also makes the process much more enjoyable, right? So we don't want to think of this as a chore to get home financing when we really should think about this as an exciting time as we're purchasing new real estate, new homes for our family.
Yeah. What are common questions that you know your clients, customers ask?
We have a lot of questions about closing time frames.
Yeah.
Because with interest rates being low, there's a lot of banks and lenders that are just really booked up, so they're having a hard time meeting 30-day closings.
Mm,
So we have people that want to do short closings, and of course we have people that want to take advantage of the lowest interest rates possible, which is really good, and look at lower down payment options. So those are all real important. And just having someone that can give you a variety of options and continuously explaining those options and how that can benefit you, I think is a really really big deal. And have flexibility too throughout the process once you get into escrow. If you need to lower the loan amount or change programs, having been able to do that without it delaying the close of escrow, that's really what we do as a lender best.
yeah. Out of all the parties that are involved in a real estate transaction, I think the lender is the most important, and like, right, because without the cash necessary to close the transaction, you're kind of dead in the water. And so I think the first step for anybody, and you probably agree, the first step for anybody looking to buy a home is to go get pre-qualified, see what your actual borrowing power is. Would you agree with that?
I do, and what not everyone knows is that the lender is the one, which I take on that role as the home loan officer. The lender is the one that not only secures the interest rate and terms and discloses that, but also we're the ones who are responsible for getting the appraisal back. So if we
Hmm.
can get the appraisal back in just a matter of days, that's going to allow you to know if you're getting a fair shake on the purchase price. We coordinate with the title and escrow company to make sure that we're satisfying all their conditions, and we also are the ones that are going to go over any changes needing to be made. If there's repairs that come back on the appraisal, we're going to help coordinate that. If there's termite, we're going to help coordinate that. So there's a lot that we do behind the scenes to make sure that everyone's symbiotic, and there's many parties at play, but communicating all of those changes and updates effectively is a really big deal. And of course, getting loan approval in a short period of time is also very important as well. But the pre-approval letter, that's your license to shop. So that's really where it starts.
Yeah.
And that's the part where you're going to meet with your home loan officer, go over income, assets, credit, and they're going to be able to generate a pre-approval letter, which is going to be what you're going to be required to use to put in an offer. So if you're out shopping for a house and you don't have a pre-approval letter and you put an offer in, then I'm willing to bet that the seller or the seller's agent is probably not going to
Take you
even
seriously.
even contemplate your offer without the pre-approval letter. So you don't want to wait till midnight on a Sunday to decide you need a pre-approval letter. It's better to get those early. And
Yeah.
with most banks and lenders, they last 120 days. You don't have to worry about them expiring.
Okay. Pre-approval letter is your license to shop. Um, when I don't know if how much you can talk about this, but you know there are obviously ratios that the bank uses in order to figure out what your ability on a payment standpoint is, right? So front end ratios, back end ratios, things like that, and they take into consideration your income, which if you're an employee is a very easy calculation. If you're a business owner, might be a little bit more difficult
Mm-hmm.
to figure out what that monthly take home is, right? And then from there, all your obligations, subtract out all your obligations, and see how much money's left over at the end of the day to be able to make a mortgage, pay the principal, interest, taxes, and insurance on the new home that you're buying, right?
That's exactly right. So we look at debt to income ratio. That's how we measure affordability.
Yeah.
So if you were not a business owner, of course, it is a lot more straightforward. And if we looked at someone just for easy numbers, say they're making 10,000 a month taxable income,
Hmm.
that's before taxes, then most lenders and banks are going to require that the debt to income ratio maximum be 43 to 50%, depending on the program that you're going with. So if you're making 10,000 per month in taxable income, then that means your total monthly debts have to be 4,300 to 5,000, depending on the program you choose.
Okay.
And that would have to include the new house payment, taxes, insurance, HOA, and it would also have to include your existing monthly debts, which would be car payments, student loans, minimum credit cards.
Mm-hmm.
And that's really how we uncover your purchasing powers, by taking a look at what that debt to income ratio is. And sometimes we find out that what we're able to qualify for someone is, much more of a loan than they would want to pay on, because the payment would be too high for them comfortably. But we do exclude rent if someone's currently renting and they're going to be stopping renting to buy a house. But it would be, your overall monthly debts.
Yeah. So, you bringing up rentals, like, do you think that the for the average person, the first piece of real estate that they buy should be the place that they're going to live in, or that it should be an income producing property for the average person?
Sure, for the average person that's paying rent and they're living in an area that has rent increases,
Yeah.
then I would say that they would really want to look into a primary residence first, if they can obtain enough down payment and afford the payment.
Hmm.
Sometimes, you live in an area where you want to raise your family and have a career, but the cost of real estate is so high, it's really hard to get into the market.
Hmm.
So that's where we see people, starting to buy rentals in less expensive areas, just to invest in real estate, with the hopes that those real estate markets that are less expensive to enter are going to be ways for them to accumulate additional equity that they can actually use to sell that home and transition to their primary residence.
Okay.
For most people, if you're paying rent and you need a tax deduction, then the primary residence is the way to go, and that's the way most people end up buying real estate, usually through their primary residence. Interest rates are lower and there's lower down payment requirements.
Yeah. I like real estate from a tax perspective, just because the tax code likes it. You know what I mean? So as a primary, if you have a primary residence and you've lived in there for 2 out of the last 5 years, and you go to sell that property, you're allowed to exclude up to $250,000 in gain. That means a married couple can exclude up to $500,000 in gain. So that could be a source of tax free income. Um, you know, Debt is not income. So if there's lendable equity on a piece of real estate, you're able to draw that cash out of the real estate without having to pay tax on it. That's a little bit, could end up being more of a deferment thing if you actually end up selling the property, but still, like, in the short term, you're accessing cash without having to pay tax on it, and that's a good thing. Yeah. So,
I'm glad you brought that up.
yeah.
So, and you spelled it out perfectly.
Okay. Great. Um, so why did you make the transition from financial services into lending?
Well, as a financial advisor here in Orange County, I came to find out that almost every one of my financial planning clients, I needed to bring my loan officer in the meeting.
Okay.
And it really is a symbiotic relationship, financial planning and home loan finance planning. And the reason being is that a large part of our expense in Orange County and Southern California is our housing expense. That's generally our largest monthly expense.
Hmm.
So when we would have someone that would come in and their housing expense was so high, they weren't able to invest in their retirement or their other stock accounts, then we'd have to look into figuring out a way for them to diversify. So if all their money's going into real estate and that's not the asset class that is going to do the best year after year, because it generally rotates asset classes,
Hmm.
then we need to figure out a way to diversify them so they have some money left over for their stocks and investment accounts and retirement accounts that their employers are matching, and have some more liquidity. So we look into possibly refinancing to get their payment down. So that was a big part of my financial planning meetings with my client. It was bringing in the loan officer.
Hmm.
And then the other piece of the puzzle was, how do we allow them to mitigate the everlasting rising rents, right? And we would do that with helping them buy a property, and then that would allow them to have like a low stable rent amount or low stable mortgage amount,
Yeah.
and then they could transition that to future savings as their payroll and paycheck goes up. They would have more cash flow than if they continue to be a renter, and then that would allow them to put more in their investment accounts. So as I recognized that was really really one of the first steps in getting financially solvent and planning your retirement in an area like Southern California, then I ended up taking over that role. And it's been 16 years, and it's the best thing I could have done. It's something that's very enjoyable to help people, really accomplish the American dream of being a homeowner and figuring out a way to help them increase their net worth with professionals like you as an excellent tax advisor that I rely heavily on for advice,
Yeah.
and also our financial advisor partner.
Got it. Yeah. So many people have so much of their personal net worth in real estate, or I mean, specifically in their primary residence. It's interesting that a lot of people in my generation aren't really investing in real estate. Like I, I I hate to use a term, but millennials, the millennials aren't investing in real estate, and it's it kind of leaves an opportunity. It might have lasting implications on the price of real estate too, in the long run. Um, but probably more on the financial stability of those individuals not getting into the game. Um, are you seeing that?
I have seen that, and I think a lot of it has to do with just the time that generation took from graduation to getting the right career and job. Because a lot of the millennial age group, there was somewhat of high unemployment
Right.
as they came out with college degrees, and so I think that concerned them and it slowed them down in some of their financial goals. So we see that there are more millennials living with family members than
Yeah.
other generations.
Uh, Student loans also, right?
Student loans, the
Yeah.
cost of education
Cost of
going
it.
up,
Yep.
12 to 15% per year.
Yeah.
They've been strapped with student loan debt. So I think that over time, they will be able to enjoy more of the real estate purchasing, but it's a little different plan for each generation depending on when they're starting their career, and it has to do with consumption and also compensation. So if you're postponing your compensation by staying in school for longer and you're consuming more expenses with the cost of education, then that's going to prolong you meeting your financial goals.
Yeah. To sum that up, it's not that people don't want to buy real estate. It's that the timing was really bad and they really couldn't buy the real estate that they wanted to buy.
I could see that being an additional challenge.
Yeah. Okay. Awesome. So I mean, I guess the bottom line is to educate yourself, understand what your purchasing power is by going to get pre-approved, and looking down the road, seeing what your plans are with that real estate. Are you going to sell it, in the next 5 to 10 years? Are you planning on holding on to it for longer than that? How secure is your job? Where do you think your income level is going to be? All those factors. Yeah.
That's exactly right. And it's never too early to start planning.
Great. All right, Chris. Well, I appreciate you being on the show today. How do people get a hold of you? How do they find you?
Okay, so I'm the home loan officer at Citibank here in Orange County, 949-226-4481, or you can find me at chris.a.williams@citi.com. That's CITI.com. I'm happy to help. Thank
All right.
you.
Great. Thanks.